I get questions to explain what a fixed rate is versus a variable rate, what an open mortgage is versus a closed mortgage. Fixed rate is that rate will be set for the term that you choose on your mortgage. So the rate will never change. So you might take a 5-year term, you could take a 4-year term, you could take a 10-year term. If it's a fixed rate, that rate will not change for the term that you take, which is good because your payment stays exactly the same. The variable rate versus the variable rate. The variable rate is based on prime. Now prime will change. It doesn't always change, but it will change quarterly. The Bank of Canada announces their overnight rate quarterly. So they review it and they look at it quarterly. If that rate should happen to change, the prime rate most likely is going to change. That means if you're in a variable, your interest rate is going to change. With that comes your payments could change, okay? So variable rate is not for people who are, I always say, living paycheck to paycheck, because the variation could be a little bit. It's also not for people that are fairly new to the market, because if they're buying their first home and they're living paycheck to paycheck, I always recommend a fixed rate because they know exactly what their payment's going to be, whereas a variable, it could change throughout the term, and it makes people a little bit nervous. It is a well-known fact that people that are in variable rates pay less interest over the lifetime of a mortgage, but you still have to watch what's going on with the interest rates, because you can lock it in if the rates go really wild, but some people just don't want to be bothered with that. So variable rates are for certain types of people that have maybe been in the market for a little while, don't live paycheck to paycheck, and are really interested in watching what's going on with the interest rates. The open mortgage versus a closed mortgage, that speaks to the penalty. If you have a closed mortgage and you want to get out of it early, so if you have a 5-year term and you want to get out of it at 4 years, they're going to do a penalty. The lender will give you a penalty. They're going to calculate your penalty in 2 different ways. One will be 3 months interest. The other one will be an interest rate differential calculation. That calculation is based on what your rate is and where the rate is at the time that you want to lock it in. It's also based on how much longer you have left on your mortgage in the term, and it's based on the balance of your mortgage. Whichever one is higher is what the lender is going to take. They want to make sure that if you give all that money back early, they're not going to lose any interest. So if the interest rate should happen to go up from what yours are, then most likely it's going to be a 3-month interest penalty. If the interest rate should happen to go down from what yours are, most likely it's going to be an interest rate differential penalty they're going to collect. So that's on the closed side, the penalty. On the open side, the open mortgage is no penalty. Interest rates are much higher for an open, but sometimes it makes sense to do an open because maybe you just need a mortgage for 6 months. Because you are trying to sell your home, or your home hasn't quite sold, or maybe it's a longer possession or something, you just need it for 6 months. Then you take an open mortgage, interest higher than what you would normally get for a closed, but then that way when you go to pay out that mortgage, there's no penalty. That's